Welcome. This is the shape of the recovery presented by the classes of 1964 and 74. The shape of the recovery, that means we're here to predict the future. And it takes a fearless person to do that. Luckily, we have a fearless person. And he is Joe Stiglitz of the class of 64, university professor at Columbia, winner of the 2001 Nobel Prize for Economics. His Nobel Prize was won for challenging one of the sort of fundamental ideas of economics in a serious way. That is the idea that markets alone are the most efficient way to distribute goods and services. And Joe showed that markets alone often are a very inefficient way to distribute goods and services. More recently, he was an early and enthusiastic supporter of Barack Obama, who is well known for challenging publicly and not always very politely some of the ways that the Obama administration has responded to the present economic circumstances. So if we look back years later and remember what Joe said today, if he was wrong, it's not because he is afraid to challenge conventional wisdom or is a protector of sacred cows. Joe's interlocutor will be my classmate, Mitch Berns, of the class of 74. Mitch is a banking, securities, and other kinds of litigator who has, in a previous life, also been a bank regulator, so he's a good person to take this on. Go to it.
I'm a little bit concerned that about asking questions of someone in the sort of quantitative disciplines, and I'll just explain that by saying I remember I was in an AP calculus course in high school, and one day my
Could you get a little closer to the mic?
my teacher in high school came up behind me, looked at a problem I was struggling with, and he was very old school, and he said, kind of sniffed a little bit at my work, and he said, "Mr. Berns, I know that your mother wants you to go to MIT and become an engineer. And you and I know that would be a bad idea, don't we?" And Mr. Barlow, I'm thinking about liberal arts. I was thinking about Amherst. Much better, he said. So with that, I think I'm not going to spend a whole lot of time introducing Professor Stiglitz. If you don't know much about him, please give up your seat to someone more deserving. But I am going to, by way of introduction, tell a story that comes by way of the New Yorker from Peter Orszag, who is now the head of OMB, the Office of Management and Budget. And he tells this story in a recent interview, in a recent profile of Orszag in the New Yorker. He said, in 1993, Orszag and Stiglitz, who was then a member of the Council of Economic Advisors, attended a meeting to discuss how the Clinton administration would respond to Norway's announcement that it would resume commercial whaling, which meant killing minke whales. According to Orszag, Stiglitz said, "As an economist, I object to imposing trade restrictions, especially against a country that just brokered this Arab-Israeli peace deal. I have an alternative proposal. How about we boycott the Norwegian Olympics?" The Secretary of State, Warren Christopher's in the meeting, and he turns to Joe and he says, "Joe, do you realize you're equating the killing of 4 minke whales with the invasion of Afghanistan?" Joe kind of leaned back in his chair and he puts a pencil in his ear and he said, "You know, you're right. How about if we calibrate the boycott and only skip those events we normally lose anyway?" like the one with the skis and the gun. We always lose that. So I'm like preparing for this thing, and I'm trying to think, how do I get out of this without thinking? Maybe I can think of a question that I can just ask the question and he'll go for an hour and I won't have to say anything else. So I was thinking about it, and this morning I finally figured on it. Okay. So here's the question. Resolved. Larry Summers is always correct. Discuss. Now, all right.
Okay.
All right. Let's get serious business. I've got all this stuff we have to do, right? All right. So now I'm going to I will ask a very open-ended question to begin with, and this comes. I'm going to quote from the professor. I'm going to quote from a review you did in 2007 of Naomi Klein's book, The Shock Doctrine. And I think this comment goes to kind of the core of the debate we're dealing with in Washington and elsewhere, and in Wall Street and Washington, and ask you to comment. This is what you wrote. Market fundamentalists never really appreciated the institutions required to make an economy function well, let alone the broader social fabric that civilizations require to prosper and flourish. And I think that's sort of a core comment about the debate that we're going through here. And if you can have anything you want to say to expand on that.
Yeah, okay, thank you. One of the things that I often emphasize is that every game and the economy you can think of as a game requires rules and referees. And how you write down the rules and the honesty of the referees has a lot to do with how well the game is going to work and who wins and who loses. If you had referees appointed by one side, you wouldn't have much confidence in the game. And in a way, one of the things you mentioned, my friend Larry Summers, he believed that you could have games in which you didn't have any rules, and in which, when things didn't go very well, when they went against your side, you got to move. You get to choose where you begin the kickoff, anywhere you want in the play. One of the concerns that I've had in the bank restructuring has been that it's close to you can think of it as close to a zero-sum game. That the banks made some very bad bets, not only making bad loans, but also on the derivatives, the credit default swaps they make. And now they make some losses. And the question is, who's going to pick up the bill for the losses? And they want the U.S. taxpayers to pick it up. And I find that objectionable. And one of the reasons why it's important, it goes back to the last sentence that you said, is if our society doesn't have confidence that the rules of the game are being played in the game is being played in a fair way, it has all kinds of further consequences. And what we're trying to do now, and what the banks have been trying to do, is have us change the rules of the game midstream. We have normal rules of capitalism. Normal rules of capitalism say that when you can't pay your bills, when companies can't pay what they owe, they go bankrupt. And when you go bankrupt, there are standard procedures. You convert, the shareholders lose everything. The bondholders become the shareholders. There's a restructuring. Clear rules of priority, not always so clear. That's why there are lawyers and judges. But there's a process that you go through. In the case of banks, it's a little bit different because the U.S. government is inevitably involved because we've insured depositors, and we've done that because you need to do that to make their financial system work. As one of my friends put it, there are two kinds of financial systems: those that have deposit insurance and know it, and those that have deposit insurance and don't know it. Because when systems collapse, governments come in and bail out the depositors. So we have a formal deposit insurance system, so we're involved. The government is involved. And we also know that when banks have almost nothing left in the bank, there's going to be a problem. You don't want to go down to the bank and put your credit card in the bank, into ATM machine, and when it says insufficient funds, it means that the bank has insufficient funds. You want it to be that it's on your account, not the bank's. And when when the banks are down to having very little money, we call them zombie banks. They're dead banks. They're walking among the living. And banks that are basically zombies have an incentive to gamble on resurrection. If they gamble and they lose, you can't be deader than dead. If you gamble and win, you walk away with the proceeds. When you lose, the taxpayer picks it up in one way or another, and we've picked it up, to the tune of, in the past, $200 billion. Other countries, it's been a substantial portion of GDP. So that's why we have rules that say that when the bank is near, doesn't have a sufficient cushion, you push it in, you restructure it. And what we've been trying to do is change the rules of the game implicitly. And that's really what a lot of the battle is about. And because we've been changing the rules, there are some very big consequences. One of them is that the national debt will be much larger than it otherwise would be. When we say much larger, hundreds of billions of dollars, perhaps in the more than $1 trillion. We're talking about lots of money here, and the amount that we've been spending has resulted in our losing all sense of perspective. When I was in the Clinton administration, we wanted to do a welfare reform, not a corporate welfare reform, but a poor welfare reform. And we needed a few $1 billion for a training program to re-educate people to move them off welfare. And we said we couldn't afford a few $1 billion. And so we wound up with a set of compromises that something that we weren't very happy with. Well, I guess say that because while we haven't had, while we were constrained short of a few $1 billion, we're talking now about hundreds of billions of dollars that we spent in a few months through Congress, and hundreds of billions of dollars we spent through the Federal Reserve without any congressional approval, without any democratic process involved. And we've done it in ways, the restructuring, you may not have realized it, but you got cheated. When we gave the banks money, we got back preferred shares. If this had been done in a private deal, whoever did the negotiation would have been fired. We got back on average, there was a congressional oversight panel that looked at this. A little aside, when Paulson went to ask Congress for money, he asked for a blank check of $700 billion. It was the most audacious act of undermining democratic processes. He said, I want a blank check of $700 billion with no congressional oversight, no judicial review, and we now know why he didn't want that. But one of the good things to come out of that was there was a congressional oversight panel that looked at it, and they looked at what we got back when we gave those shares, when we gave them, the banks, those money. We got back shares, and at the time, we got back about 67 cents at the dollar. We got back shares that were going down in value. So there were shares that nobody reasonable would have taken if in a private deal, but even at that moment, we got cheated. So that means that we're going to wind up with a much bigger national debt than we would have otherwise. And, money, the basic law of economics is that resources are scarce, and what you spend on one thing you don't have available to spend on others. It has been the largest redistribution that has ever occurred in a space of time, but in the wrong way, except for one example, and that was in Russia when they privatized the state resources and gave it to a few oligarchs. But apart from that, it is the largest redistribution of wealth that has ever occurred, in such a short span of time.
Can I ask you a question about the consequence of that? When I try to sort of think about this and get my mind around it, I fail all the time. But to some extent, what seems to be happening is we got a bunch of huge amounts of assets that were created that are bad, financial assets that are bad. The government has. I'm sorry. We have a huge amount of bad financial assets out there. The government coming in and basically dollarizing those assets, sticking itself in as an intermediary, and backing things that are denominated as debt of this entity or that SIV or whatever, and now it's dollar good through the government, and so you pump out huge amounts of currency. And my question is, I guess, when do the guys holding the dollars, like the Chinese and the Russians and whoever else, figure this out and say, dollar's not such a good bet, and then what I'm going to do for a mortgage?
Yeah. Well, what is true is that this kind of anxiety is growing. I've been to China twice this spring, and you do get a strong sense of anxiety. It's been, of course, exacerbated by the fact that their sovereign wealth fund decided to go into the American market at just the wrong time, and they bought a big chunk of Blackstone, and they then lost about 2/3 of the value. And China has about $2 trillion of reserves. I mean, they've been saving a lot. We've been saving. They save about 50% of their GDP. Our personal savings rate was down to 0, just to give you a contrast to future-oriented behavior. But the average Chinese person, thinks of those reserves as their own money. Sort of like theirs. And they feel like they got somehow swindled on that Blackstone. And now they're very worried about the U.S. government doing the same thing to them. The premier got so, reflecting the kind of popular anxiety, warned American, gave a lecture and said, we don't want you to renege on your promises. Of course, the U.S. will always pay the promise because we can just print money. So they say, we'll give you $1, we can just print the dollars and give it to them. They figured out that that's not the real problem. It's not a reneging on the debt. It's the fact that the dollars will be worth much less than they are today, and that is either because of inflation and or exchange rate decrease in exchange rate. Those are real anxieties. I think those are real anxieties. Now, what the Fed would say is, don't worry about it, because for the next year or 2, 3, 4, 5, we're going to be in a recession. And the result of that is that unemployment's going to be high. Electricity's going to run out. Things are going to be hard. And that's going to mean a downward pressure on wages and prices. But eventually, we'll recover. We recover from every economic downturn. And the worry is that when we start to recover, all this liquidity that is in the financial system will can start getting spent, and then we could have inflation. What the Fed says is, don't worry about it, because as soon as that happens, we will deftly take out this excess liquidity from the system just as it's needed. Now, anybody who's watched the Fed for the last few years may not have quite that confidence in the Fed, and either under the current one or a potential next governor of the chairman of the Fed. And I think that's right. I mean, I think if I were describing what the Fed has been behaving, it's more like a drunk driver who's veering from one side of the road and sees he's going off the road and steers the other way and then goes off to that side and goes back and forth. I think there's an equal chance, though, that we may have inflation, but the other, probably even more likely, is that they'll slam on the brakes too hard and we go back into a deeper recession. It's somewhat in the genetic code of every central banker is they hate inflation. There have been a few that somehow got inoculated against it, but most central bankers, before you become a central banker, it's sort of in your bloodstream. And so it is more likely that in the worries about inflation that we go into, we have our recovery stymied by the worry of this. And let me those of you who haven't been following it, what the Fed has been doing and what the federal government has been doing is unprecedented. We really are in uncharted territory. The Fed's normal balance sheet, which is a measure of how much money is out there, has normally been around $800 billion. And in a few months, it went from $800 billion to $2.5 trillion, and has announced that it's going to go up by another $1 trillion or so. So this is big, but these are magnitudes that we've never had before. If you include all of the guarantees, all the other programs to our financial system, Bloomberg has tallied the total number in the magnitude of $12 to $13 trillion. Now, we hope most of those won't go bad. Well, you should be praying. The federal deficit next year is expected, or this year is expected to be somewhere between 10 and 13% of GDP, which again, outside of war, has never been in this order of magnitude. We began with a big deficit, and we're getting into a more difficult situation.
Are we hooked on the dollar as a reserve currency in terms of credit costs and our ability to finance housing and sell paper around the world? And are you worried that we may lose that status as a result of all this?
And this concept of reserve currency, most countries hold dollars in their reserves as a symbol of the confidence in the currency, the confidence in the country. And I mentioned China has $2 trillion. Other countries, the reserves have increased enormously in the last 10 years, partly because of the way that the IMF and the U.S. Treasury, some of the people that you mentioned before, managed the last global crisis, the East Asia crisis. They managed it so badly they converted downturns into recessions to depressions. They took away economic sovereignty. I talked to the prime minister of one of the countries. He said, we were in the class of '97. We learned what happened when you don't have enough reserves. And there's been this enormous accumulation of reserves. Well, for the United States, it's been a mixed blessing, partly positive, but partly negative. Positive in the sense that we can borrow very cheaply abroad. Right now, we're borrowing at close to zero interest rate abroad. The negative side is that as they were accumulating dollars, we were exporting T-bills, these government bonds. But the flip side of that is that we were, rather than exporting goods and services, automobiles, we were exporting T-bills, and that wasn't creating jobs. So the trade deficit that's been a real problem is the flip side of the accumulation of reserves in other countries. Well, countries held the reserves as in dollars because they believed the dollars was a good store of value, a sound currency. But over the last 9 years, they've been disabused of that. They no longer think of that as a stable currency, and so China's now moved about a quarter out of dollars, and that's going on in other countries. The problem is particularly severe because right now they see this enormous risk that we were just talking about, this enormous risk of a potential inflation, devaluation, the depreciation of the dollar. And at the same time, what is the reward that they're getting? A zero return. Their citizens are asking, why are we holding dollars? We have investment projects at home that can get a positive return. We can lots of other things. We can hold other currencies. Isn't this risky? Isn't this a waste of our? So it's risk without reward, is what they're saying. So this is becoming a big issue in many countries. China has put it very forcefully. They've actually said that they want to think we ought to begin an examination of alternative global reserve systems and move away from the dollar. And I think it actually, I've been advocating moving away from the dollar reserve system. I think it's not good for the United States, and I don't think it's good for the world. And my book, Making Globalization Work, I advocated moving away from the dollar reserve system. And I'm chairing a UN commission, and one of our strongest recommendations is for the creation of a global reserve currency. And obviously, with China supporting this view, it's gained some legs that it might not otherwise have had. And a number of other governments have now expressed interest. Why that's important, of course, is this will be a big adjustment for the United States. It will mean that it will be more difficult for us simply to go out and say, we want to borrow more money, and people will just automatically want to hold those dollars. So the fact that the dollar was a reserve currency made it easier for us to engage in the kind of debt finance that has characterized the U.S. over the last number of years, and it'll make the decisions more difficult for us.
So let's say we have problems with the dollar, one way or another. We change reserve currencies. What's that going to mean for? Are my kids going to be able to buy a house? Is credit going to be more expensive? What's going to have to change to accommodate a rebalancing of the system?
Well, I think those are hard. Those are hard questions. One of the things that you already see and it's begun to be talked about in the last couple of weeks is that while the Fed has the ability to affect the short-term interest rates, the T-bill rate, the market has a bigger effect on the longer-term interest rates. It's been intervening in the longer term, but the spread between the short term and the long term is an important variable. And the spread between the longer term government rate and the longer term rate at which ordinary individuals borrow at is another. So there are these two spreads between the government T-bill rate and then the long-term government rate and then the borrowing rate of the mortgage. The fact is that those spreads are increasing. And one of the reasons they're increasing is this worry about inflation. And another reason they're increasing is the worry about whether we will be able to tap into this international market as easily as we have done in the past. And just to give you a picture of this, in 2007, I think it was, the United States borrowed about $850 billion from abroad. So here, the richest country of the world could not live within its means. It's a very strange picture of a global economy. A lot of economists said, oh, don't worry, this is just, some people borrow, some people lend. But, and we happen to be the borrowing kind. And we have an advantage, a comparative advantage in consuming. Chinese have a comparative advantage in saving. And so, each people do, we do the things that we do best. But there was another view that said that this is not really the way you ought to be running an economy over the long run. And in particular, something I hate to mention in this audience is that we have an aging population. And the baby boomers are, of which we are, well, you're not, but I am, reaching close to retirement, and that we will therefore we should have been saving for our retirement, for medical care, for Social Security. So as a country as a whole, we should be in a period of heavy savings, not consuming beyond our means. So there was something very peculiar. It was not sustainable, and I think it was a very, as I say, a misguided set of policies that led to this. So the bottom line is, if a country lives beyond its means for a while, that means it has to live below its means to pay back the money that it's borrowed, and our children are going to be among those who I think will have to bear the consequences of the mistakes that we've made.
I'll switch gears a little bit and talk about a couple of trends that may have sort of bumped up against each other and caused a problem. We've had so much financial innovation in the last 15, 20 years since the creation of mortgage-backed securities, derivatives, the whole gamut that has all kinds of benefits, risk diversification, whatever it is. And then over the same period, we've had a push for transparency in accounting, financial regulation, disclosure. The SEC, when there was an SEC, was very hot on this sort of thing. And it's reading the papers, it seems like what we've run into is a situation where financial innovation has gotten so successful and complex that when we ran into problems, transparency disappeared because no one could see past the first layer of the balance sheet. And what do we do about that? Do we have to restrict financial innovation? Do we have to regulate it? Do we have to do something else?
Well, first let me say I'm a little bit less enthusiastic about a lot of the innovation that has occurred. We ought to first remember what financial markets are supposed to do, and then we ask how well they've done and whether the innovation really helped them to do it or whether it actually hindered. Financial markets are really not an end in themselves. They're really a means to an end. You don't eat financial markets. You don't wear it. It doesn't gives some people enjoyment because of the complexity. It's like solving a puzzle. But for most people, for our economy as a whole, it's a means to an end, and it's supposed to do two things. It's supposed to allocate capital, manage risk, and it's supposed to do it, if it's efficient, at low transaction costs. Well, our financial markets misallocated capital. Hundreds of billions of dollars went into areas where they shouldn't have gone. A small percentage of our financial markets did what they're supposed to do and are among the best financial institutions in the world. Our venture capital fed money into Google, into the other new innovations that really have transformed our society, biomedical, lots of. So we shouldn't criticize all of the financial system because a lot of it was doing what it's supposed to do, but a lot of it was not. And a part of it that was not was some of the stuff that you were referring to. It also didn't manage risk. It actually managed to create risk. It also did this at a very high transaction cost. At one point, they were, profits in the financial sector were 1/3 of corporate profits. Now, it was sort of like the thing that was supposed to be a means to an end became an end in itself and ate up what it was supposed to be serving. And just to give you one example of where it didn't innovate in the way that it should have, or I'll give a couple examples. Modern technology means that we should have had a very efficient electronic payments mechanism in the United States. It should cost pennies for the cost of when you go in to a retail store and buy a good, for the record of that to transfer money from your bank account to the retailer bank account. We have the technology for that to be done, really costing pennies. How much does it cost? It's 1-2% or more of the transaction. they've resisted the financial system creating an efficient electronic payments mechanism. And you pay for it every time you purchase anything. And whether you pay for cash or not, you pay for it. Because they're not allowed to charge you for the cost of using a debit card or a credit card. So, in effect, it adds up to billions of dollars, billions and billions of dollars every year that are hidden. You don't see it. It's not transparent, but it's part of the cost that you bear. Now, another example, there are other countries that have good mortgage systems. Denmark has had a good mortgage system for several hundred years, called Danish mortgage bonds. Financial markets, not only in the United States but elsewhere, have resisted these kinds of things. So what were our innovations? Our innovations were really, a lot of them, designed to engage in what I call regulatory arbitrage, accounting arbitrage, tax arbitrage, getting around the regulations. So they were very clever. They would move things off balance sheet because there were requirements of what you had above the balance sheet. You moved them off. But they were so clever that even the banks in the end couldn't figure out what their own balance sheets were. And they knew that they didn't know what their own balance sheet was, and therefore they knew that they couldn't know the balance sheet of anybody else to whom they might lend. And so that's why our credit markets froze. They created an enormous amount of complexity. And so we had this system where we had transparency on the one hand, disclosure, but disclosure of things that, you take some of these over-the-counter derivatives, they're so complex that people couldn't figure out what they were, and they've blown up. Companies, when they blow up, we're talking about payments of billions of dollars. The buyers didn't know what they were getting. The sellers didn't know what they were selling. One day AIG says, we're short 10 billion. The next day it's 20 billion. By the time now, we taxpayers have paid almost 200 billion.
Can I ask a question about that? There's talk of firms trying to get out of the federal program, pay back the money so that their executives can get bonuses or whatever. And I think Goldman's in there, and some other firms are trying to talk about buying their way out of TARP at this point. Do you think that that they should that there should be some consideration of, say, not only direct money they got, but the indirect through things like the AIG bailout?
Obviously. I mean, I mentioned before that the total set of programs is $12-13 trillion, which include government guarantees. In the case of, say, Goldman Sachs, the AIG was bailed out on the grounds that if it wasn't, the claim was the whole economic system would fall apart, that there was systemic risk. I was really very suspicious of that, and as were some of the other people. Gretchen Morgenstern wrote an article about who was in the room when the bailout occurred, and it was head of Goldman Sachs was in the room. The Fed, U.S. Treasury, refused to tell us where the money was going. It went into the AIG, but it went out right away. In fact, some of it, I was told, the checks were written directly. They didn't even go into AIG. They went directly out. When I say we're talking about $180 billion, so this is not a little money. It became clear that you started hearing rumors. Much of the money went abroad, and then they still refused to disclose it. Eventually, I sort of worked with one of the congressmen to demand, wrote a letter saying, we as taxpayers want to know where that money went, and finally they disclosed it. And it turned out that, yes, Goldman Sachs was the largest recipient. The biggest amounts of money went abroad. So it wasn't even saving America's financial system. That it was, if Deutsche Bank was at risk, then the German government should have bailed it out. Why should American taxpayers be bailing out Deutsche Bank? Goldman Sachs said, "Oh, we were never at risk. We didn't need the money." So then you ask, why are we, why are we paying them? Goldman Sachs has not offered to give us the money back, by the way. So they kept the I think it was $10 billion. It was a lot of money in any case. Not by the scale of what we're talking about. When you're talking about trillion, it's hard to keep your hands around what is a small number and what is a large number. But I think most of us would be happy with a little chunk of that money. But the bottom line is that the TARP money is just a small fraction of the assistance that they've gotten from the government. And one of the things, and this continues, these gifts continue. When we bailed them out, we got back preferred shares and warrants. Warrants are the right to buy stock. And it was supposed to be, okay, when you exit, that's part of the price you paid for getting the money in the first place. So the question is, the banks want us not to exercise the warrants or to sell it back to them at a deep discount. And Treasury's been doing that. And it's just, inexplicable to me why they're continuing to just literally give money to the banks. And these are supposedly healthy banks.
I think at this point, can we open it to questions? One up there?
Yeah, just, the fact that Henry Paulson came out of Goldman Sachs, that Tim Geithner was connected with Goldman Sachs and with the Fed, how can we as individual citizens, do you think, stop this from continuing? How do we stop the kind of giveaway that is going on with the Treasury and with the Fed? How do we demand that the Fed open up its books? I know there are some pending bills in Congress to try to get auditing of the Fed's books, which they're resisting. What can we do as individuals? Is it just pressure our representatives and senators, or is there something more that you think we can do?
Well, I mean, clearly pressuring congressmen on these issues, and particularly specific issues. I mean, for instance, in the aftermath of the Watergate, the U.S. passed an important law, which is called the Freedom of Information Act, and which gives us, rights as citizens to find out what our government is doing. And a number of other countries have now adopted these kinds of laws. Sweden has actually had that law for 200 years. The Fed claims that it does not have obligations under the Freedom of Information Act. It says, we have no right to tell you what we're doing. And even though what it's doing is, in effect, costing you, potentially hundreds of billions of dollars. The Fed has moved from being a lender of last resort to being a lender of first resort. I joke, those of you who remember your American history and the debate about Alexander Hamilton wanting a strong national bank, never in his mind did he have a bank as strong as the Federal Reserve, which has been lending to large American corporations, not small companies. That's one of the aspects I should have mentioned, that the money has been channeled in ways not to the banks that are doing the lending to small and medium-sized enterprises, which are the source of job creation for the most part in our country. It's been going to the banks that prided themselves in moving out of the lending business. They prided themselves in moving into the moving business. And if you ask, one of the big disappointments is that lending is not restarted. And the reason is that we haven't been focusing on the financial institutions that do the lending. And so it's not a surprise that it hasn't worked. But to go back to your question, one needs a lot of pressure on not only the general, but on the specific issues like the warrants. Why are you giving away the warrants? On the case of the derivatives, what the government did on the AIG case, it bought out the derivatives, which meant derivatives were obligations. They were like an insurance policy. But again, Gretchen Morgenson wrote a beautiful article in the New York Times. It was like, what they did, it was like, let's say you had a fire insurance policy. A fire insurance company had a fire insurance policy on your property. Now, normally, what happens when it decides that you're too big of a risk? It just cancels you, and you have no recourse. Okay. Well, AIG didn't do that. What it did was exactly the opposite. Let's say that you are insured for your house is worth $1 million. So I'll cancel your policy and I'll give you $1 million, as if your house had burned down. So it canceled the policy, but paid off as if the worst disaster that could have imagined had occurred. With our money. And to me, so somebody ought to be agitating about why in the world did you do this? They have not provided any explanation. A few courageous reporters have been getting at some of the things that have been going on. And every time, and to give you one other thing that's very important, there's a lot of pressure from the administration to shut down the Congressional Oversight Panel. Yeah, Elizabeth Warren's panel. There's pressure to shut it down or to fire. Elizabeth Warren is a professor at Harvard Law School who's been very courageous, has been leading sort of the charge of trying to, figure out what to do to try to have, for instance, a financial product safety commission so that the products that are sold are safe enough for human consumption. Not surprisingly, some of the financial institutions are not very happy with her. And they've been putting enormous pressure to shut down her operation. So it's very important to make sure that if they try to do that, that there's a real strong outpouring saying, this is our only protection. These are the people that are pointing out we're getting, I mentioned 67 cents on the dollar. On some of the recent deals, it's down to 25, 30 cents on the dollar. So we've really been cheated in some of the more recent deals.
I take it, do you think we should have let AIG go down or just cut a better deal?
In the case of AIG, we should have let it go down. What we should have said is, if there is anybody who has a counterparty, it has a derivative that is systemically important, we'll come and help you. So if Goldman Sachs would have gone down because of the derivative, which it says it would not have gone down, but it would say, if that is the case, it could come to the government and say, we need $10 billion, and then we say, okay, we'll give you the $10 billion, but in return, we want something of value. What do we get in value in terms of AIG? Nothing of value. We're not going to get paid back anything significant out of the $200 billion that we've given them. So, this is another example of kind of trickle-down economics. You throw in $200 billion at AIG, a little bit trickles down to someplace where it's important. But let's go directly to where it's important. And get something back in return.
What arm of government do you think would have been competent to make those distinctions that you're suggesting be made?
That's a hard question because, the New York Federal Reserve was in bed with all the banks. I don't know if you know the structure of the New York Federal Reserve. It's basically not the head of that is not appointed does not get ratified by Congress. It's a board of the banks and the business community. Treasury should have been, but I'm not sure I would have felt confidence in that. I mean, we had a political problem at that moment. One of the suggestions is that I've been supporting is we need a financial stability, an independent financial stability commission to make those kinds of judgments, partly because the Fed is too close to the banks inevitably, and not just in this administration. I mean,
At this point, you think the Fed would be sort of like a self-regulator at this point?
the Fed is very much like a self-regulator. It's not completely. There are some people in the Fed that have been more critical. There were people, there was one of the members of the Fed, as the housing problem was growing, was saying, what you're doing to poor people is outrageous. You're giving loans that they're not going to be able to repay, and it's going to cause a systemic problem. And he was trying to stop, and the Fed had authority to stop some of the worst practices. It chose not to do it because all the people that they knew were friends, and there was a big party going on.
Do you think usury laws should be put back in place for credit cards? Is there any real reason for somebody to be loaning money if they're going to be charged more than 20%?
Yeah, I do think usury laws should be reinstated. And it's a difficult question because you know that a few people will go into illegal money lenders. And you don't want people to have their kneecaps broken, and we do, even in our society, there are loan sharks that are out there. I mean, and usury laws have the effect of encouraging some people to have to go over into those illegal mechanisms. But what I think, I really think that there have been two problems with with not having the usury laws. They have been taking advantage of people who really, of the fine print, of people who don't understand what they're borrowing. Part of the problem is that it has actually increased the returns to the financial markets because they found, this is part of the innovation. They found how to find, the way I put it, one of the big things in economics in the last 10 years is the discovery that there was money at the bottom of the pyramid. And what the financial markets said is it shouldn't remain there. It should go to the top. And they worked very hard, and they figured out ways to do that very, very, very quickly. So I do think that when you look at the benefits and the cost, I think the benefits of reinstating usury laws are important. One of the things, let me just say one other thing that's really, I think, an important critique of our banking system in general is that, in developing countries, I've been in Botswana, for instance, where the banks managed to serve poor communities in rural areas, that they managed to you might say, the bank the poor. We still do not provide adequate banking services to many parts of our country. And the result of this is that we have this huge industry called payday loans. And those are another example of usury, which are targeting some of the poorest people. And the one where I found it absolutely outrageous are the payday loans outside military headquarters, where you have young kids that have been that have gone into the military or fighting for our country, and you have these payday loans. They're not getting paid very much for risking their lives, and then you have the payday loans come in and take out so much of the little money that they're getting.
Joe, two-part question. First, I think Goldman and others are now selling insurance on the U.S. debt, right? And I can't imagine that there'd ever be a possibility if conditions were so bad, the U.S. would default that they could pay. So isn't this just the same ridiculous, thing all over again? And secondly, wasn't the real problem sort of the momentum of the meltdown and the uncertainty of it? And so stepping in may have been hard to sort of think through because it was a matter of stopping a chain before it went somewhere because of the imperfection of information, something you know a little bit about.
Okay. Well, on the first question, it is true that there's a market on betting on the default of the U.S. It's on there are betting markets on that on all governments. The market is saying that the probability of the U.S. going into default is much higher than it was. It's gone up significantly. One of the curious aspects of the whole market was you probably heard these numbers where the magnitude of the credit default swaps were in the trillions of dollars, and you say, how could they have trillions of dollars of bet? Our GDP is only 14 trillion. And what was happening was they were A would bet B, and then they would say, well, rather than undo, when they decided to undo it, they would, rather than cancel it, what they did is B would bet A, the opposite would A bet B. Okay, so these were gross numbers rather than net. And you asked, well, why didn't you net them? And then they said something like, well, what difference does it make? Well, it doesn't make any difference except if A goes bankrupt, then B owes A, but A doesn't owe B because A is bankrupt. And so then it doesn't net. So then you ask them, well, didn't you worry about that? And they say, oh, we couldn't believe that anybody would go bankrupt. And then you ask them, the products you were selling were bets about people going bankrupt. That was your whole industry. Now, and I guess it always astounded me that people live in a schizophrenia, that they go around with two sides in their minds in a way that was quite incredible. There was a second part to your question?
Just that they had to step in quickly, didn't they?
Oh, yeah. Yeah, that's an excuse. The fact of the matter is, this is a problem that was more akin to a slow train wreck. We saw it coming. It began, those of us who were watching it saw it happening in 2005-06. They were issuing crazy mortgages. We were aware of the problem, the gross of the problem I just described on credit default swaps. So there are lots of risk going on, okay? In 2007, the market began to freeze in August of 2007. They should have begun to make contingency plans. They didn't. February 2008, Bear Stearns goes down. Anybody who was following what was going on, everybody knew that Lehman Brothers was next. It was almost common knowledge. The Fed still didn't do anything. It said a little bit ex post, oh, we didn't have authority to do anything. Well, if you didn't have authority, why back in February didn't you go to Congress and ask for authority? Now, it's a little bit of a lame argument because the next day they said they had authority for AIG, which nobody thought they had authority for. So, it is a lame argument. But to me, the major point is they should have begun to think about these issues. And you should have begun to think about what you did with Bear Stearns before Bear Stearns went under. And the way they handled that was again, not very good.
All right. I've always wanted to be Bill Buckley. Thank you, Professor Stiglitz.